Uh, is anyone else? Let's actually unmute people. Oh, I guess I think.
Hey, I can hear you, and yeah, I'm gonna mute myself.
All right, guys. So you guys can, if you have questions, post it on the chat box, or you guys can unmute and ask the questions. So let's start this session. Uh, you know, uh, all right. So we're going to talk about the risk management. There are many different ways of handling risk management, right? So you scale in a position when you're getting into a trade. Don't try to buy full size uh, for any trade, unless it's a confirmed breakout with price action and volume, then it's different. But otherwise, always try to scale in a trade because the premium that you buy in will always fluctuate and come down after you get in as well. So it's more often than 8 out of 10 times it happens. So that's one way of actually managing your risk. The next thing is, from Tradingwiser rules, I've always mentioned that if you're doing weekly options or bi-weekly options, then use dollar amount as your risk. Okay. For example, if you actually have a $25,000 trading account and say, you put in $2,000 on a trade, if that's your risk, and if you're doing a weekly options or, 2-week expiration options, then define it as, what your, your trade size is $2,000, but what's your risk? If you decide that, okay, 50% is my stop loss, then instead of trading for $2,000 on each trade, you buy only for $1,000 for weekly or bi-weekly options and let it go to zero. Because if the trade doesn't work, and say you buy in for full size, which is $2,000, and your risk is 50%, but you buy it for $2,000, your premium can fluctuate on a weekly and bi-weekly option expirations, right? Because the premium can go from, say $2 that you buy for a particular, say Tesla, for example, 325 calls last week we had, and we logged in some profit, then it went back to 310, and the Tesla 325 calls went as low as 50 cents or a dollar, right? And if you had a risk of 50%, then you bought in at $2, at $1 you would have got out. So instead of that, you actually just buy in for $1,000, which is, if your trade size is $2,000. That way, what happens, you actually don't have to worry about guys, can others mute your microphone? Probably there's a lot of disturbance. Okay, thank you. So what happens in that case is that, when you're buying only for $1,000, you don't have to worry about what happens to the premium. If it goes up and down, you can hold it until the expiration day, which is Friday. This way, emotionally, you're not logged in and you're more objective in your trading. And plus, you're using the stop loss as your buying price for the trade. So either ways, you're mentally prepared that it's going to go to $0 if it doesn't work. In other words, your stop is hit. Okay. So that's why it's really important that you use a dollar amount when you're trading weekly and bi-weekly. That's one of the Tradingwiser rules that I've mentioned. It helps you not trade with emotions. You become more objective and you have a defined risk. Okay. Now, let's say you're trading, you're buying trades. You don't want to do weekly, but you want to give more time, and you end up buying for monthly or 3 months expiration, right? In that case, then you start using support resistance as your stop loss. Okay. So in that case, you can use a daily closing candle or a 4-hour or a weekly closing candle. So the longer the time frame you have on your option expirations, say 3 months, then try to use a weekly or a daily stop as daily time frame as your stop. If you're using, say, a month, then you can still go with 4-hour or daily. Okay. And the reason for this is, the longer the time frame you have for expiration, you want to give a bigger time frame for your stop loss, and always use closing candle. Do not use just because the price touches your stop price, do not get out. Always use the closing candle. Okay. Now the other way of managing your risk is, let's say you got into a trade. For example, Tesla. We had a lot of people last week, 325 calls. I did not use I broke my rule, and I did not use my 4-hour as a closing candle for stop. Instead, it tagged and it went way below it, which is below 315, which was a 4-hour time frame, and I took a stop on it. Okay, so let me actually. You guys are able to see my Thinkorswim charting tool, right? Type in on the chat. Yes, perfect.
Yes.
So last week, what happened? If you take a look at the 4-hour,
Yes.
you'll see that
Yes.
I was using this and it stopped and it went way below. Wait, this is the wrong time. Sorry, hold on. Let me actually go to the recent one. Where was that? Okay. So you see this 4-hour candle? This is when I took a stop. It went below, but it closed at 318.71. Do you guys see that for that particular 4-hour candle? And this was a rookie mistake I made, right? I mean, it's bound to happen where I get carried away with emotions when I'm managing so many different things. So in this candle, if you take a look at it, it went as low as $309, but the 4-hour closing price was $318.71. Okay, I broke my rule, I got out. Okay, but many people held it, they stuck to the rule, and then what happened? For next day or two, it came back again, testing it, and it went low at 314.50 and then closed at 318.21. So again, it held the 4-hour candle, okay? And then, your 325 calls went in the money by $16.5, okay? The day high by Thursday was 341.50. So a $2-ish stock price that we bought, a premium that we bought for 325 calls, hit 800%, okay? So it's really important that, when you're defining these risks, you stick to the closing candle for that particular time frame, okay? Now, the other ways of handling this risk management is you can scale out of your position. Always do that, always. The most important rule is try to get out of your position, buying price on any trade as soon as possible, okay? You're in a Tesla trade, 325 calls, it doubled, take your cost out, okay? And then it's a house money. Then you can ride the entire, till the expiration day and see how it works, okay? So scaling out of a trade is really important. And when you scale out, lock your profits or lock your cost out and hold always certain position size so that you can scale out into different target zones and the higher target zones. And this is a really important risk management tool because this helps you to stay in the trade and not end up missing, hitting big home runs in case the trade works pretty good and goes way higher, okay? That's why I've defined target zones, because you can scale out of your profits at different target zones, at or near target zones, okay? If say a particular stock goes close to the target zone and it doesn't exactly hit the target zone but misses it by 50 cents or $1 or something, and you feel comfortable about taking a profit at that moment, take it. There's no harm in taking profits, okay? And you can either take your profits in target zone 1, 2, that's up to your risk profile. If you want to hold it longer, you have less number of contracts, and you don't mind holding it for a longer period of time, then sure, go ahead. So whatever suits your personality, fine tune it according to that, according to your system, according to your trading style. It's really important. Another important way where, a lot of people actually do that, I also, when I trade and I have too many different strikes of a particular trade, for example, Tesla, I have next week 350 calls. I have November 22nd, 350 calls. I have 10% position size left. I have November 22nd, 370 calls, right? Now, when you're actually having, say, different strikes, or you just have one strike of a particular trade, and if the position doubles and you make 100%, another way of handling that risk is, you can roll out of that position completely. So you can log the 100% profit and you roll it up to a different strike just using the profits. Okay, for example, 325 calls last week before I got stopped out, they went from $2 to I think they doubled. Okay, $4 something. Let me see. I think I mentioned it on my Twitter. Let's see. Okay, so these are the ones, right? So you see, it hit 3.9. Okay, before it went down and stopped me out. So it's 2.3, 2.4 is what 2.45 is what I paid, and 3.9, that's like almost 50%, right? So one way of doing it is like, you lock your profits, whether it's 50% or 100%, and you roll it up to a different strike, only the profits. So say you bought 10 contracts at $2.40, that's $2,400. Don't worry about the fees, okay? And it goes to 390 for 10 contracts. That's $3,900 in return, right? So your net profit is $1,500. Now you can use that $1,500 and roll it up to a different strike for just $1,500. This way, you're playing with the house money. So this is another important strategy where you can utilize this. Rolling up if you're doing calls, rolling down, if you're doing puts, or either ways, right? So that's another risk management strategy. The other important point is avoid over trading. Don't try to trade every stock. Don't try to follow if you follow many people in FinTwit, and don't get carried away by people, talking about this stock is moving, there's a news on this stock, and it just jumps up 5-10%. Don't try to chase a stock. If you don't have a trading plan, more than 80% of time you'll end up emotionally trading it or gambling it, and you'll end up losing on that trade. So don't try to overtrade. Have a focused list. That's the reason I provide you guys a watch list every Sunday. So you guys focus on only those lists, and that way you can see if there's any support resistance where it actually dips back and it holds that, then you can add onto the position, or you can take a long position on that particular trade. Okay. And the last point is, opinions don't matter. There's so many people in FinTwit and everywhere will talk, bears and bulls, they'll have their opinions against a particular stock. So don't follow that. Try to focus on the charts, focus on the price action, focus on the news, see if there's any event happening for that particular stock that you're trading. And the most important is, I've been trading for 11, 12 years. And what I realized over a period of time is the volume actually is a big confirmation, right? So a stock can go up, but if you don't have enough volume to, back it up, it basically is kind of a fake breakout, okay? So the volume always helps. Try to follow the volume. And if you want to play a breakout for any particular strategy, see if the volume is higher than a daily average volume of 21-day or 15-day volume is higher than the current volume when it's a breaking out. These things are really important. These will help you, confirm your a stock breakout and give you more confidence. Okay, so moving on to the next slide. You guys know about the TW rules, right? So I've talked about the point 1 in risk management, where if you trade any option for $2,000 and have a stop loss of 50%, then trade only for $1,000. That way your emotions are out. You're more objective in your trading. Okay. If you're doing monthly or longer date, then use resistance and support or trend lines. The support and resistance points that I'm giving you on the watch list, trigger sheet, etc. I've talked about scale out your profits. If you're comfortable scaling out 70% of your position size, go ahead, do it. If you're comfortable scaling out 100% of it, once it hit 100% profits, do it. Fine tune the system to your personality, to your risk appetite, to your risk profile. It's really important because everyone thinks differently. Everyone has a different risk appetite. It's really important that you fine tune these rules even more further to your own personality. Okay. It's like not every cook, can make for example, pasta, uh, can make the same pasta and will taste same for everyone, right? Every cook is different. That's how you need to fine tune your strategies and your rules. Okay, don't try to overtrade. The point number 5, 6, and 7 is basically, try and understand what kind of trader are you. Are you the kind of trader who has a lot of time and can spend time on charts, can look at news, can monitor the screen every minute or second or every hour of the day? Then then do weekly options, do bi-weekly options, take those kind of option expiration trades or buy more time if you need. If you're a trader where you don't have enough time, then try to buy more time. So any option trade that I post as an alert, if you're not comfortable taking the weekly, buy another week's time. That's okay. Or buy a month. It's okay. You might pay a premium on the buy price for the options, but it's worth it because if it dips, you can add to that position, looking at 4-hour or daily closing candle and see if it holds that support. Then you can add on those places, on those supports, add an additional size and ride it longer. Okay. If you don't have time at all during market hours, then do 1 month, monthly expirations. Do monthly, 3 months, 6 months. Those are the kind of option expirations you need to do, because if you don't have time to look at all, then you're going to be looking at those stock price once in a day or once in a week or something like that. And if you have any time, say 3 losing trades at a time, right? Then take a step back. Okay, see what you're doing wrong. Okay, why the trade did not work? What happened to that? Analyze your trade. Analyze the chart. See what happened. Did you get stopped out or what happened? And if you think that maybe you did not give enough expiration time, then buy longer dated expiration and get your confidence back again, and ride it. Okay. All right. Let's see. If you guys have any questions, post it on the chat. Do we keep the same? Okay. For the buying time part, do we keep the same strike? So, good question. So, if you don't have to keep the same strike because they're going to be a little more expensive, but don't try to go way out of the money from the strike that I provided. Okay. So it's good if you're buying a week, say you're buying next week's, okay, then you can buy the same strike price, or you can buy the immediate next strike price. That way you can try and match the premium value or the delta value that's there. But if you're buying a month down the line, then a weekly expiration, for example, 325 calls on Tesla. Let me give you an example. Okay, 330 calls of Tesla for November 15. Were $3. I actually have that position along with weekly 325 with all of you guys. Okay, so but 325 for November 8 was $2.45, but November 15th they were, I think they were $5. Okay, so let's see. Let's go to Tesla options. So 325. Okay, so this was on not October. Okay, November 7th, Tesla jumped up. November 6th is when I got stopped out. So if you look at 325 calls for November 15th expiration, the low was $3 when Tesla hit $309. The high, it opened at $4.55, and I was holding 330 calls from November 5th for November 15 expiration. Okay, 330s were $3, and if I go to 330, for November 15th, I took a stop. They went as low as $2, okay? But the high was 656. So I took a stop. So I took a stop and, you know, I wrote it higher. So the point being that, you know, for the next week, basically to answer your question, you can buy the 330 calls or you can buy 325 calls by paying $5, which is almost twice the premium price on a weekly, okay? All right, so let's.
TW, one quick question.
Sure.
Yeah, you said the volume is the confirmation. So what exactly is that? So how to identify whether the stock is going to go down or going to go up? So where we
Okay. Let me give you an example, okay? So let's take Tesla because we traded that a lot last week, okay? So before it's, you know, on, what is that, November 6th? I think that was Wednesday. So if you look at the volume, it's 7.94 million, okay? But the previous day, it was 6.9, and before that, 8.7. Now, I look at 21-day or 50-day volume as well, okay? So if I do this, on my chart, it's set it, I have set 50-day and 21-day volume. So let me minimize this. Let's go to the daily. So if you take a look at this, 6.9 previous day. Why is my, okay. Okay, this particular chart doesn't have the volume for the, let me actually open another one. Okay, this is what I was saying. Okay, so if you look at this, here it is. So on November 5th, the volume was 6.9 million, okay? But look at the 21-day volume. It's 6.9, it's 16.5 million, okay? Now the next day, the volume was 7.9 million, okay? It was higher than the previous day. And the following day, we had 14.5 million. So you take the volume for 21 days and you see what is the average. You see the Y on the volume section that is given, it says 23 million, okay? So basically I use 21 days and 50 days for volume.
And is this volume only for options or does it also include?
No, this is a stock volume. So you take this is a stock volume.
Okay.
Okay, this is not an options only volume. So you take your volume and compare it to your 21 days or 50 days average volume, and then that way you'll see, you know, what is your daily volume compared to your 21-day volume. If you're actually having a daily volume which is higher than your 21-day or 10-day or 50-day volume, then it basically tells you that you're getting a lot of buyers in or sellers in. Okay, it's a high volume. So now how do you determine whether it's a buying or selling? Well, if you're seeing price moving from low of the day to high of the day, there's a huge difference. Like example, on November 6th, the price, the low of the day was 314, the high was 326. Okay, but the volume was only 7.9. But look at next day, it gapped up and you got almost double the volume. Okay, so that confirms that, you know, buyers stepped in next day and the price went from 328 to 341. Okay, so it was day one of the breakout was November 6th, day two was this, day three it stalled. Okay, and before that, there was a red bar which was lack of volume, 6.9, because the November 4th, the volume was 8.7. So if it was a breakout from this pennant, the next day, November 5th, we should have got a higher volume and a good price action. We did not receive that. So it was still stuck into that, it was a failed breakout, okay? Because you see the price, it closed at 317, which was below the pennant breakout value. okay? And it was also from the previous closing price, same previous closing price. The next day you got the volume confirmation and also the pennant broke out, bull flag, okay? So you use volume which is, compared to last previous day volumes and see whether the volume is higher than last day or 2 days, and then compare it with your 21-day volume or 50-day volume. This way you can get the confirmation if you're getting today's breakout, whatever you're getting is a higher volume breakout or not. Okay.
Thank you.
So look at this. On the earnings day, October 24th, the volume was 29.8 million. The 21-day volume is 19.1 million. That confirms you that you got a high volume break, and it's a gap up. The next day you got 30 million, and the 21-day volume on the y-axis that you see on the volume section below is 21.728 million. Okay, so these are confirmation that you had volume breakout, and this confirms that the breakout is true breakout. But we already had earnings gap up day 1. This is day 2, and day 3 is normally day 3 is where the stock will actually make a high and pull back, and will stall or pull back next few days. That's how it normally works. Okay, 7 out of 10 times day 3, and then stock will normally pull back or stall. There are 3 occasions, 3 out of 10 times where you might get day 4, day 5, depending on if there was a news or any kind of buyout or anything. Okay. All right.
In which tool
Guys,
you
you guys,
using right now? What is this tool?
this is Thinkorswim. So I use Thinkorswim for charting.
Okay.
All right. Let me move forward, guys. So let's talk about these 2 important option strategies. A lot of you people were asking about this. Okay. Normally, the reason I've been posting only naked calls, naked puts, or long calls, long puts, or long, all of these is because a lot of people don't have knowledge about option strategies, and hence it's easier to actually post straight calls and puts rather than post a strangle or a straddle or call spread, put spread, etc. Okay, so let's take Tesla example. Let's go to Tesla. Okay, so let's take Tesla. Let's say we bought next week's 350 calls. Okay, so let's say you want to make a call spread. Stock closed at 337.14. Okay, so what you do is you buy the leg 1. You decide whichever strike you want to buy. The closer to the stock price, the strike is, the better the chances are for you to succeed. Okay, the better the probability of your trade working, right? If it is a true breakout. So I'm choosing 340 calls, and how do I determine the second leg, which is basically which strike do I determine? I can choose 350, 345, 370, anything, but I'll look at the charts. When I look at the charts, I'll see what is the potential that Tesla could go to. Okay, so let's take weekly. The weekly, Tesla is trying to break this trend line. Okay, you see, each time it tested the trend line, it failed. There are only probably 1, 2, 3, 4, 5, 6 or 7 occasions where Tesla actually broke out of the trend line. And last Friday also, it tried to break out of the trend line. It went to 341 and it closed below that. Okay, so what is the next resistance here? I think the next resistance is this big red bar, which is around 352. Okay, on a weekly. Why? Because you have a low here as 353. You have previous low 350.76, almost 351.6. So here also, if you see, it's 350 as a closing price, and 354. So basically 352 is basically a resistance point, because a lot of times it came there and it failed. So the option strategy that I would use for a call spread for the second leg would be, let's say Tesla by end of the week would close at 350. Okay. So what I'm doing, I'm buying Tesla 15th November 340 calls. Okay. And the 340 calls are basically 510 bid, 525 ask. So let's say the mid price is 520, and I'm selling same amount of contract size, where the bid is 231 and 235. I'm selling at 235. So 520 minus 235 would come approximately to 285. Okay. So basically, what is my risk reward here? So the risk is, say you're buying 10 contracts, you buy the 340 calls, you sell the 350 calls at 285 per contract. Your risk, your break-even price is 340, which is your strike price, plus 285 is the premium that I'm paying. Okay, so that's basically 342.85 is your break-even. So by the end of week, on November 15th, when option expires, if stock closes at 342.85, that means I don't make any profit, I don't make any loss, I just get my money back. Okay, but if stock goes and closes 350 or above, then I make $7.15, which is basically 350 minus 340. 350 is the second strike, minus the 340 the first strike. It's $10 minus the premium you paid, which is 285. That gives you $7.15. So $7.15 per contract into 10 contracts gives you $7,000, and your risk. Your max loss is the buy price, which is $2.85, which is $2,850 if you're buying for 10 contracts. Okay, so this is nothing but call spread. The same thing if I decide Tesla is going to go down, then or any of the stock that I choose, then I choose say for example 340. So I'll choose, let's say, let me delete this. So let's say I think Tesla is not going to cross 340. It will go back to 330. So I'll buy 340 puts. Sorry. Okay, I'll buy 340 puts. And I will, let's say, for simple math, I'll just put one contract, and I will sell, 330 puts. Okay, so I'm buying one contract of 340, and I'm selling one contract of 330, considering that Tesla is not going to clear 340, or it will close below 340 by end of the week, because it's also monthly operation OPEX, right? So my one contract would cost me, why is it $4? 340 and okay, yeah. My one contract would cost me $450, and my max profit was going to be 350 minus 340, which is $10. 340 minus 330, which is $10. So 10 minus $4.50 is $5.50 per contract. Okay. All right. Let me actually finish the option strategies, guys, and then I'll answer these questions. Okay. So if you guys have any questions on the option strategy, let me know now. If not, let's move to the next one.
Yeah.
Okay.
Yeah.
Butterfly.
I have a question, right? When we have the vertical spread, right? There is a risk of assignment, right? Somebody maybe exercise their option and then we get assigned. I experienced it that earlier. So how do we avoid that?
Vertical spread, you wouldn't have if you okay, the vertical spread, if you're having only, so in this case, right? So you bought a higher strike and you're selling the lower strike on the put side, or on the call side you're buying the lower strike and you're selling the higher strike. Okay, you want to close your position before the expiration or before the market closes on the expiration date. Okay, or close it way before. If you're profitable, within the spread, and if it's profitable trade, then take your profits out. That's otherwise you'll get assigned. Why? Because you're selling the 350 calls and the Tesla say closes at 360 next week, and you do not close your spread, so you're going to be assigned 350 because you actually collected credit because you're selling the 350 calls. Okay, so try and close the spread by selling 340 and buying back 350. Make sense? Because you're doing buy to open 340 calls and you're doing sell to open 350 calls. That forms a spread, a vertical spread. So you do the reverse by sell to close your 340 calls and buy to open your 350 calls. That way you close the spread and you won't be assigned anything. Okay?
Okay.
All right. So moving on to the next one, guys. So the butterfly. Okay, the butterfly is basically a strategy where, if you think a stock has a particular range and it's not going to go beyond that range in the entire week or a month or whatever expiration you're choosing, then butterfly is a very good strategy. Okay, but you have to time and pick the right stocks. Don't try to pick like extremely volatile stocks like Netflix, Tesla, Google, Amazon, because more of the time these stocks are very volatile and they can, break out in a big way. Okay, so let's say Tesla, I explained that, Tesla is not going to go beyond 350 next week. Okay, so I can have a butterfly strategy where, I buy butterfly comes with 3 strikes. So basically you're going to have 3 different legs. Each, when I say leg, is basically a particular strike that you're going to either buy or sell. Okay, so in the butterfly strategy, you buy the lower strike. If you're doing calls, you sell you sell twice the quantity of the next strike, whichever you pick, and you buy back 1 quantity of the highest strike. Okay, so in the case of Tesla, the stock closed at $337. Okay, stock closed at $337. Now, let's say I'm not expecting Tesla to go about 350 next week. So I'm deciding that, I want to do a spread, a butterfly between 340 and 350 because stock is already at 337. I can also do 335 if you want. If you want to have the lower strike to be in the money and the next strike to be out, next 2 strikes to be out of the money, you can do that. Okay. So for easy calculation, I choose 340 calls. I buy the 340 calls. Okay, for simple math, let's do 1 contract. I sell 345. Why? Because this week Tesla closed at 341ish, so I'm not expecting it to go beyond 345. Okay, but I buy 350 calls. Okay, now when I'm buying the second strike, when I'm selling the second strike, this middle leg, right, the middle strike, I need to sell twice the quantity of total number of contracts compared to the lower and higher strike. Okay, that's basically the butterfly strategy. And you always want to have equal distance, equal strike differences between either legs. That is basically what completes a butterfly strategy. If you're, let's say, okay, so let's finish this. So you bought the 340 calls and you sold 2 of 345 calls and you bought 1 350 calls. Okay, so this basically means that I'm not expecting the stock to go beyond 350 by the end of the week, but I think Tesla is going to stall. It might go about 345 during the week, but by expiration, Tesla would close below 345 or at 345 or lower. Okay, how much do I spend on this? I'm buying it for 61 cents. And what is my profit? So the difference of middle strike 345 minus the lower strike 340, $5. So that means $5 minus 61 is my buy price. That basically gives me $4.39. You see this? So if Tesla closes at 345 or it closes at below 345 and above 340.61, 340.61 is my break-even price. Why? Because my lowest strike is 340, my buy price is 61 cents. So my break-even, if Tesla closes at 341, I make 341 minus 340, which is 1 minus 61 cents, 39 cents per contract. If I'm actually, if Tesla closes at 349.39, that's again a break-even. Okay, why? Because remember, you're buying one contract at lower strike, you're selling two contracts at 345. So let's say if Tesla goes to 350 by end of expiration, that means my 340 calls will be worth $10 at expiration. My 345, because I sold two of those and I collected credit, it's going to be 2 into 10, $20. And my 350 is going to be zero, because at 350 at expiration, the premium value is zero. So that means it's, I'm pretty much not making any money, right? It's $10 minus 2 into $5. That's $10. So 10 minus 10 is zero. In fact, I lose 61 cents per contract because if it closes at 350 at end of the week by expiration. But so your break-even price is 340.61, or it is 61 cents below your highest strike, which is 350. Now let's say Tesla closes at 345. That's where I make the maximum profit, okay? Because I'm selling the second leg. So you want the stock to close below the second leg because you're selling and collecting credit, okay? So when you see the stock close at 345, I paid 61 cents per contract to make $4.39 per contract. So that means for 10 contracts, I invested $610 and I made $4,390. Okay, this is a really important strategy. So paper trade it few times, test it out before you actually decide to, do with real money. Okay, so I'm reading through the chat. So hold on. It has to remain between we'll have a loss of well, it has to remain at 345 or below and above 340.61. Okay, if it is above 345, then you're not going to make any loss. It's just going to end up being what do you say? Let's say the stock closes at 346. Okay, your 340 calls are going to be worth $6. Your 345 are going to be 2 into, because you sold twice the quantity, so that's going to be 2 into $1, $2, okay, at expiration. So you actually made $4. Does it make sense? So it's the max profit is always close at 345 or below. 345 is a max profit, yes. The max loss will be premium you pay. So in this case, you might make a chance to. So again, compare these with, what is the chart telling you? What is the range move that you think you can expect on a weekly time frame or a daily time frame? Okay, just don't blindly trade butterflies. It's really important that you compare what the stock is doing, look at the resistance and support areas, and then choose the right strike price. Okay. So that's why I was saying that, when you pick a stock, don't try to pick Tesla. Don't try to pick Netflix. Why? Because they are really volatile stocks, okay? Because they move based on news extremely. Pick a stock like, for example, you can pick, let's say, which one? Let me tell you. Let's say, is it P? PG, Procter and Gamble, is that what it is? What is the
Walmart, I think.
Yeah, let's say PG, Procter and Gamble, right? Look at this. They don't move much. Look at for weeks, the low is what? 116, the high is 125, $9 change. Okay. It doesn't move much. And for how many weeks? For 4 weeks, it's been in this range. So if you take, yeah, Walmart is a good example. Microsoft is a good example. Look at Microsoft on the sideways. So when you see a pattern where, the stock is moving sideways, it's a pretty good stock to play butterfly, because, it'll go to the low of the range. Look at the low of the range for Walmart, 116. For weeks, it's been 117, 116.66, 116.56. For weeks, it's been that, okay? And the high has been 120.71, 121. So you can buy, if you're doing Walmart in this case, let's take a look at Walmart, okay? So 116 and 120.75 is the range, okay? So November 15, the stock closed at 119.44. So 120.71 is the max. Now let's go back to the charts and see what is the high before that. So 121 is new all-time highs. Million percentage R is turning upside on a weekly. The daily tells me that, it's going to hold this, or it might come down to 117.84. So you can, so this is the low and this is the high. Okay, so let's see what is the, let's draw the fibs. So the max it can go is 123. Okay, so 123 and 118, 117. Okay, so that's the low, 117. So 117, 121, 123. These are the three different strikes. So let's go to the trade. It's already at 119.44, November 15. So if I choose, I'll choose, I'm expecting it to not go above this. So let's take 117, 120, and 123. So let's say it actually breaks out. Okay. So, okay, so this is a breakout, 4.2, 3.6, 4.4, and pull back on a 3.8. Okay, so if this holds on Monday or Monday or Tuesday, then this can make new highs, which is 123. So I'm assuming that it's going to stick around here. So I'll just go with, so I'm saying that it's going to stick around 119. So I'm choosing 119. I'll buy the 119s. Oh, shit. Hold on, guys. I think my battery is going down. That's why. Okay. All right. So I'm buying the 119s. You guys are with me? And then I will sell the 121 because 120.92 is the previous highs. So I'll sell the 121, 119, 119, sell the one, jeez. Okay, so I'm buying the 119, selling the 121, and I'll buy the 123. Okay, so let's say I'm doing 10 contracts. So I sell the second leg for 20 contracts. My buy price is 24 cents, and I'm going to make $2 minus 24. That's $1.76. Okay, that's basically $1.76 is $176. That's 10 contracts, 1,760. Okay, so my risk is 24 cents. My reward is 1760. So if you take a look at this Walmart strategy, the chart tells me that, the daily mid Bollinger Band and 21 MA is back testing right now. So on Monday or Tuesday, it just holds 119. It can reverse back up and it can, confirm the breakout and go to 120.92, which is the all-time highs. If that breaks out, it can go max to 123 because that's 161.8 fibs. Okay, so if it goes above that, if it goes above one, so what we took is 121. If it, as long I'm expecting that because it's monthly operation OPEX expiration, 120.92 all-time highs would be tested, and we would still close below it. Okay, because it's a monthly OPEX, and you can expect on the breakout a lot of volume coming in for that particular strike. So 24 cents per contract is the risk, or $24 in other words, and you're making $1.76. Okay, so that's basically almost 700 or 800% return. Okay, hope this helps you guys. Is this good?
Hey guys, yeah, this
Oh,
is
I did-
amazing. I have a question, sir. In this one, right? So near November 2015, do we have to do a closure on this trade, or do we just leave set it to expire?
Okay, good question. So, you know, so I'll tell you one thing, okay, if it depends now, okay, technically, you look at the charts and see, you know, if you're getting a breakout on volume, and if it is closer to 121 or it's going higher than that, okay, you don't have to wait till end of the expiration day to actually close that or leave it as it is, okay. You can lock your profits way before. Say Monday, Walmart tests 119, it breaks down and closes above it. And Tuesday or Wednesday, it moves up and tests 120.92 and makes or hits 121. Okay, at that moment, your butterfly would be, instead of $1, instead of 24 cents that you bought it for, will be worth $1. Okay, it might not be worth $1.76 because there are 2 or 3 more days left for the expiration. So you're not going to get the maximum benefit out of it when you're doing spreads or butterflies or any of these things. You need to wait till Friday, till last hour or two, where, you know, the stock is around 120, 121, and, you know, then premiums are literally, there's a lot of huge premium decay, so you can maximize the profit. So let it expire. If you think the stock is not going to go above 121 by Wednesday or Thursday, then, and you know it's pulling back, then you can let it expire if it's hovering around that. If not, it's always better to take your profits and, you know, 24 cents, and if you're making $1, that's still good. That's like almost 300, that's 300% for you. So, but butterflies, normally you expect them to expire. Normally you would leave it till expiration. But for that, you need to know how the characteristics of a chart is, how that particular stock is actually acting. And if you look at, in this example, if you just look at Walmart for weeks, so technically I would let it expire, because if you take October 7th week, 120.71, 120.6, 120.717, then 119.7, and then last week 119.44. So you see this, it's been hovering around 120.6 for last 5 weeks. Okay, so technically, if this time if it hits 120, so because it's a monthly OPEX, I'm expecting that it's going to it might just hit 120.7 or 120.9, and it'll just pull back. Okay, so if it goes there and if you're profitable, close your entire butterfly. Take your profits. Don't try to hit maximum. If you're going to try to hit maximum, then you're going to have your emotions involved and you're going to be stressed over it, because you have to hold it till Friday. Okay. Well, when you open a butterfly, another good question on the chat, right? So do you have to close the butterfly in any certain order? So butterfly, if you take a look at the butterfly trade that I'm taking here, this is one trade, one transaction. Okay. So when you buy one transaction, all 3 legs in one transaction. You're not putting a separate order. You're not taking a separate transaction. If you're closing it, you do the same thing. Okay. But let's say, you know, you want to convert the butterfly into a spread, or you want to just be long multiple strikes of that Walmart, for example. You can go ahead and, if you think Walmart is making 121 and above, and you want 121 by Wednesday or Thursday, or you want to, like, you know, on Monday it hits 121 and you think it's going to go a lot higher, you can go ahead and close this middle strike, and you'll be long 119 and 123 calls. Okay, so it just depends how you want to trade it. But if you're trading a butterfly strategy, you want to close all of them together. Yes, when I trade earnings and anything, I do use, I have my own strategies. I've been like doing that for years. So I just don't blindly play earnings. It's a calculated risk. I use technical analysis, combine it with previous last 3-4 years of earnings history, what percentage of implied move that has happened every time. I combine all of these things with strike price, with implied volatility, with intrinsic value, with with short float, and all of these I combine with that and look at the time frames and chart size, the range price for the entire stock, and then I decide the earnings play. That's why if you take a look at the last week also, so many earnings, when I know Strangle worked a lot, right? Strangle did good. Plant, Strangle did good. GH did good, right? All of these were Strangle plays. Why? Because I know they make huge moves. They have done that in past earnings, okay? Whereas if you look before that, we took CHTR. It was naked calls because the chart setup was there, and it was a pretty, they had pretty much, they beat 7 out of 8 earnings, last 8 earnings. So yeah, there are strategies on all of these. All right, guys. So I think, what's the time now? It's been 1 hour. Let's actually move forward. If you don't have any questions on the option strategies, I'm going to move forward. Okay. Let's go with the market outlook, and then we'll have another 20 minutes to take any chart requests. Okay. All right. Okay. So what am I think? What do I think? What happens in the for the next week, right? So let's look at SPX or SPY. Okay. So I'm looking at SPY. Let's actually go with this. So, I don't think it's a good time to still short. I understand put call ratio is higher, but I don't see a sign where, it's going to pull back easily, because everyone in the FinTwit or everyone is expecting a pullback. And I'll tell you why. Okay. Look at UVXY. Okay. UVXY clearly tells me that, more downward move is going to come. Okay. It's not been able to clear the 8 EMA, the green line. It's been struggling all along. And on Friday, it came down. It's a bearish engulfing pattern where the high is 1865 previous day, low is 18.1. On Friday, it was 18.79 and hit 17.84 low and closed at 17.85. Okay. So the previous low is 17.73, which is 11 million. This one is 13 million. So on Monday, I still think that, it can push lower and move towards $17, $15.50, something like that. Okay. That's why I think UVXY tells me that, we still have to see a pullback. Okay, let's see this. Okay, so let's move to, if you look at SPY, it's been holding this trend line all along. The only time I would go bearish is moment the SPY closes below this green line on a daily close. If it happens, then I know it's bearish. Okay, it doesn't matter if you're getting a spinning top or shooting star candle on a daily. It doesn't matter. I mean, only if I get a confirmation next day and it closes below this 8 EMA moving average, then I can expect that the trend is changing. Okay. The other thing is it's also holding this trend line. Okay, it's also holding this trend line. If you take a look at this, it's been holding this trend line. Okay, every time it just held this trend line. It came down, tested. So once, twice, 3 times, 4, almost 5th time, and 6th. Okay, so it held this trend line. Only when this trend line breaks, and you know what happens when this trend line breaks? It's not only going to go below this trend line, it's also going to go below this 8 EMA, and it's also going to be below these multiple days low closing price 1, 2, 3, 4, 5. So if it closes below this, so let's put a alert 306.81. So if it closes below 306.71, the closing price here is 306 or 307. Open or closing price the same, 307.1 and 307 here. So if it closes below 307, then I know 306.52 will get tagged. If it closes below that, then the trend changes, and we can expect this to go down to 21 MA, which is around 302. Okay. Similarly, if you take a look at the weeklies, the only thing I see on the weeklies here is William percentage R is extremely overbought. Okay, and you can see a dip here. So I'm expecting that on next week that it's going to be premium chop and pinning action. So you can expect 1 day to low or sideways movement and test the 80 EMA, which is 306.5, and this would actually reset the William percentage R as well. So we'll pull back to this and hold this, and close the week about 306. That's what I'm thinking. So 306 is your key reference point for next week. If it closes below 306 next week, which means we're getting a weekly close of 2 weeks, this last week 306, and this week's, if you close below 306, it's 2x reversal. So then we can expect this to go to 302-ish or something. So green line is 8 EMA, yeah. So basically, I think we're just going to stall around sideways to chop and pull back to 306. So I'm still not bearish. If you're thinking of shorting it, anything, I'd rather short stocks that are weak rather than short the indices, because it's going to be choppy action and it's going to try and pin it to 306. If I take SPX, if I take SPX, on a weekly, it broke out this channel, this trend, and it made new highs. So it's all along, it's been holding this trend line. So I do expect this to go higher. The Bollinger Band is also expanding on upwards. So my price on the upside is going to be, it cleared my 161.8, which is my old fibs. It's going to 3,129, 3,132. I'm thinking this, I do expect SPX to go there. Look at this. These are 423.6 fibs. These are from way old. These fibs were created long time before. So, bear with me for this chart. But if you take a look at this, also it broke out of this trend line. Yep. So 3130 or 3140 is what I'm looking at. So 3130, 3132 is basically 423.6 fib. So I think if SPX decides to continue higher next week and frustrate, the shorts or the bears, we can go and, if we break out of 3097, likely we can go and see 3129 to 3132. So that's my upside for the next week. That's SPX and SPY. Let's look at VIX. This is a key reference point here on VIX, 11.7, 11.5, or $11. This is normally the spot where, market pulls back and reverses. So there's still room for VIX to go down. Like I mentioned, UVXY also has a lot of room to go down. there's still room for VIX to go down. Look at it. It normally holds here. So if it decides to break this 11.69, it can go down to $11 and reverse. So another 30-40 cents, it can stall there and pull SPY or SPX down. So 306 is going to be a key spot to hold next week. Okay. If not, if SPY makes new highs, then you will see VIX to see $11. And $11 will be a spot where I'm going to be looking at buying puts, and because there are high chances they're going to see a pullback after that. Okay. If you look at VXX, on weekly, it's yet to hit 261.8 pips, okay, which is $18. So looking at VIX, looking at VXX, it's still not out of your lower Bollinger Band. Look at this. It's yet to get out of the lower Bollinger Band, okay? The price is still inside. Every time it pushes out, it bounces. So $18 on VXX, $11.69 on VIX, and UVXY going to $17 or $15.50 are the downside spots that you need to be aware of, which will likely cause SPY or SPX or market to pull back. Okay. What else? So let's look at CNN. And also put call ratio. I'll talk about that as well. So it's extreme fear, but I'm at 91. So this is, all of these are aligning to one thing. Look at the greed at 91, UVXY, VIX, VXX are almost there to reverse, SPY almost there to reverse, NASDAQ almost there to reverse. So I think this week is pretty crucial. So if we break 306 on SPY, we will be looking at, getting some put plays. Okay. And if you look at put call ratio, could you also show the internal tickers? Yes. Good point. Okay. Let's look at internals. Okay. So I use these internals. Internals are basically telling you that, if underlining in the market is actual buy and sell is actually happening or it's just fake. Okay. That's what internals tell you. See the advanced declining volume. Look at this. All along last week, it went down, then gapped up. Every gap up has been fading. Then every gap down is getting bought. Okay. And it's been happening every single time. Let me actually. So look at this. You take any time. If you take October 21, there's a gap up, it fades. Okay. The next day, gap down, bounces up. Then here, gaps down, bounces up. Then pulls back on news, then moves back up again. Every gap up is trade, every gap down is buy. So this was based on the news, it bounced up. Okay. So I think Trump announcing about China deal phase 1 and etc. Okay. The recent news, again, it gapped up. Okay. Where tariff, China and US last week. And then again, if you look at this, it faded completely and then hit the support here. This has been a strong support and I've had this for like months. Okay. It's been a strong support. Every time it hits this trend line, it reverses. So, and the other thing is there's hardly been any much big volume in ticks. Anytime you have ticks above 1,000 or below -1,000, that means the market tends to move towards that direction. Okay. So if we have, but if you look at it, we hardly had any ticks above 1,000. So it's just been sideways movement all along. And this has been for, look at it. So if you look at this, from October 21st. It went up 1100, and then that's it, right? So there was one attempt, and after a few days, another attempt, another attempt. So all this was spiked on news, nothing more. Last week also, we had a news, it hit high of 1641. Oh, sorry, 780, okay? And 600, right? So these are all indicating that, there's just been sideways movement. It's not been like, there's not been actual buying happening in the underlying market. It's more of, news-driven market where it's just getting, nobody's buying it much. It's just been news-driven, and they're just pumping the market. That's it. So be really careful if you're trading SPY, SPX, any of these things. Buy more time. Don't try to do same-day expiration. If you notice, we have not done much SPX trades, okay? The last attempt was a week or so ago when we tried to take the SPX puts and it failed. Okay. All right. So what else? Okay. So the put call ratio, right? CPC. Actually. So look at the put call ratio. Put call ratio basically tells you what? It basically tells you the if people are buying more puts because they're scared of the market. So it basically indicates that people are expecting a pullback, they are hedging it, or protecting the longs, or they're shorting the market. In other words, right? So here the put call ratio is really low. It's 0.59. Normally at 0.525, 0.5, 0.5152, you see all along it reverses. This is what happened last Friday. It came to 0.53. Before that, Friday it came to 0.54, and it's reversing, right? So so if you combine this with UVXY, with VIX, VXX, CNN, all of these are indicating that this is not the time for you to be excessively long. This is not the time for you to be extremely long. Just be a little cautious. Don't trade too much. We had a good week. We made good money last week. So when you're trading next week, take smaller size. Okay. See how the market is acting, because longs can get killed easily now. So we might chop and then reverse to the down, pull back. Either this week or next week, because all of the indicators are telling me that internals, CNN, WIX, UVXY, everything is telling me that we are there for a pullback. We are due for a pullback. So be extremely cautious next week, watchful, and be very selective when you're trading. Okay, we are in our Teslas. We'll try to dump Tesla as soon as possible because it's November 15th. If 340 on Monday, if 340, 342 breaks and runs, great. If not, we'll try to take the profits and get out of it. Because if it doesn't, then it's going to wait for next week, because one, this is monthly OPEX, so the MMs are going to try to hold Tesla down, and two, November 21st, which is next Thursday, not this but the following Thursday, is when Tesla is going to reveal the semi truck. Okay, so I'm expecting for the Tesla to run up on that week rather than this week. So likely I will try to close the Tesla on Monday or Tuesday, depending on how it's acting to it. Okay. So okay. All right, guys. What else? So I think this is pretty much we've done with the market outlook. All right, so I think I'm still creating my watch list. You guys can see this? Type in yes if you can see the watch list. Great. Okay.
Yes.
So I've already completed for until UVXY because I was trying to do it as fast as possible. I need to update. There are a few stocks that I'm noting that actually are going to be basically, there are a few stocks that I'm actually looking at, which is going to be basically the earnings run-up trades, because those will move fast and those will give us better risk reward. For example, Regeneron, we already in it, so that's one of them. Let's see. I'll post the watch list tomorrow. I need to spend a few more hours to look into what are the best setups with respect to risk reward and options pricing. Other than that, I'll see if there's any good earnings. We'll try to avoid the earnings because that's what we did. I think last week I did not take any earnings trade other than what I posted. It was, I think, trade ideas, but a lot of people took the Expedia. Expedia was one of the best. It always moves. Expedia is one stock that actually always 8 out of 9 times on earnings it moves. So I have been, building these lists for years. So yeah, I think I'll post these. You guys have 10 more minutes. If you guys have any questions, set up charts and lines. Okay, what do you want? Set up charts. I think I'll have to take another session to, talk about setting up charts and lines. Think or swim or anything. So I use. Okay, so I use,
Yeah. Sorry.
Sure, go ahead. Who's this?
Yeah. One question on a quick risk, on risking the money, right? How many, say if somebody has like 10 grand, right? So how much the risk is recommended risk per contract,
So again, see, that's what I was telling you guys, right? So if it depends on your risk profile, okay, there's no one recipe for every trader, right? For all traders, right? So if it's $100,000 account, normally I would recommend use $2,000, 2% or 2%, 4%, 2%, 2 to 5%, okay, per trade, okay. And if you're doing weeklies, don't put more than 2 grand, right? I mean, unless it's you have to make a judgment call at that time that if the trade is really good, then you want to add more. It's up to you. But if you're doing 10 grand, then you probably should do maximum $500 per trade, because if you try to do $1,000 or $2,000 on a trade, you'll end up depleting your account. If things don't work out, you'll be out in 5 or 10 trades, right? So that's why maximum is $500. In that case, then if your premium becomes 50% or double, take the profit, get out, right? Don't try to hit big. Target zone 1 hits, get out. Take it, get out, right? It dips back, you can get in again by using your profits and ride it to target zone 2, 3, whatever it is, okay? So I hope that answers your question.
Yes, sir. Thank you.
Okay, so BIIB, I know, don't look at my charts. I need to clean these up, but let's actually look at this. I have too many indicators, too many lines. So if I look at BIIB, let's look at the daily. Okay, so this is it's a bull flag, right? Wedge pattern. It's breaking out. So Friday, well, we had decent volume. It reversed and it held. So basically the low on Thursday was 285, 285.2. So it's a reversal candle on Friday. So that's good. So watch on Monday. If you get volume 1.5 and above, preferably, yeah, I would prefer like 1.8, 2 million. If we get Monday volume as 2 million, that confirms the breakout, and we can go to 306. So we can see 302, 303, yeah, 302, 303, and then 306 can take, if 306 gets taken out, then yeah, you have 310 and 318. So BIIB looks good. It's heading towards this big weekly bar, which is high of 330. That's where I'm thinking. But it's not going to break this 330 for a few weeks. Why? Because this breakdown, 330 on weekly, was on 33 million volume. Okay, that's huge. Okay, so that's a huge seller sitting here, right? So it needs a lot of buy volumes for weeks to actually catch up to these 33 million. So we got 34 million, 10 million, 7 million, right? So I think it's just going to consolidate for some time. It's holding the 200 MA weekly. So first test close below, second test pass, third pass. So watch next week. Next week 307 is a big breakout to 310, 318. Okay, so VIB is good. I think. Well, let's see what is the 301, 302. Let's see. Let's look at the options. So it's 293, November 15. Yeah, 300 calls is a good play on VIB. Yep, it's bottomed here. So yeah, 300 calls is a good play on VIB. So this has room to 300, 303, 306, 307, 306, 307. So if this clears 310 and 318. So it needs to clear 306.92, 300 and 306.92. So these are the key spots. Anything? All right, that's that. Let's look at ZM. I think someone asked me about ZM. I did tell you guys about ZM. ZM. Okay, so look, ZM broke this pattern. It bounced up and it's holding the long trend line resistance here. Okay, so the key for you to go long, look at $71 is your long spot. Okay, so if we get 71 clearance, it will be 4 weekly close and it heads to 74 quickly. So it's a good volume on Friday. So Friday had decent volume, but you still need to clear 71. 71 is key. So if 71 is the spot where you need at least 2 million volume. If you don't get 2 million on a daily close, and it will stall around that and it'll pull back. So yeah, be watchful of ZM on that. Microsoft. Okay, let's see. Oh wait, there's Apple also, right? Okay, let's do Microsoft and then we'll do Apple. Okay. Yeah, I think I was looking at Microsoft on Friday. This is bullish. The weekly volume is not much. I think that was previous week was earnings, right? Okay. So earnings, good gap up. Yeah, Friday was decent volume, right? It was lower than the Thursday volume. So the volume is not that much. Look at it. All along 18, 17, 18. So the Friday was 16.7. So yeah, I'm thinking that, a pullback down to 144 and then reverse back again. So if we clear 146 on Monday, then this can go up to 148, 150. I think that's what I have. Let's see. Hold on. This is a breakout, no doubt. So the gap needs to hold. Yeah, 149 and 150, 160. Okay. So Microsoft, this is a breakout as long as 142.65 holds on a weekly close, you can be long. And look at, yeah, 147 and 150. Yeah, these are the spots I would look at. So 148, 150, 151. So hold 144 and daily close 144 key, weekly close 142.65. Okay. As long as this gap holds, this is the earnings gap. So to me, this is strong. So if the earnings gap holds, this can just chop. It might go up, come down, test the 142.65 again for weeks, and then break out. Okay, it needs to reset William percentage R as well. So yeah, MACD is about to cross, but it needs to reset. So I'm expecting next week to sideways movement, and then test 142.65, and then try and clear that and go higher. Okay, so that's with Microsoft. Apple. Apple is pretty strong. MACD is rising. When you see this, you know, when you see this on the in any stock, when you see this expansion of MACD on a weekly is a pretty good sign that this is rising. So it can go to 281. Okay, it's not going to happen in a day or in a week or few weeks. It's going to take time, but Apple looks good, and as long as 255 holds, yeah, 255 is multi-day low. So as long as 255 holds, which is also the close here, yeah, earnings gap, earnings high close also is 255.93. So as long as 255 holds, look at this alert I put 254.54. Okay, let's put 255.78. So as long as 255 holds, you can stay long in Apple. If you're holding a stock, just stay long. Apple is good. I know a few people in front of it were shorting Apple and trying to, you know, be smart. But yeah, I think it cleared 261.8. Apple is fine. But during a market pullback, which I was talking about earlier, UVXY, SPY, etc., which is almost at the spot of reversal, I'm expecting, you know, Apple and other stocks to pull back as well. Okay, just to reset this volume percentage R, all of this. Look at this on the weekly also. It's overbought. An overbought condition can stay overbought as long as it wants, right? But look for signs. Okay. Anything else? If the market is strong or bad, trading a stock, and which one is before light? So, you know, if the market is right now, market is holding the trend line and it's strong, right? So always, but indices have already made new highs. So there's not much room in terms of, like, if you look at SPX or NASDAQ, there's not much room to make a lot of new highs, right? It needs to reset. Okay. So I would prefer trading individual stocks. If you're going to trade indices, then try to, you know, buy time into SPY and SPX. Okay. So look at this, 61.8, always it held this. Then it came up 78.6. So weekly tells me 88.39. So this likely we should see this by December, Jan, you know, on NASDAQ and everything. So, but market is due for a pullback so that it can reset the overbought condition. So recent high is 8447. So that's what I'm looking at. Okay, it's holding these trend lines. So use these indicators. I would prefer trading stocks more than indices. Okay. All right, guys. I think it's an hour 34 minutes. We are good. Let's call it a night. Thank you all for joining. I'll stop the recording and I'll post this so it's helpful for you, all of you guys. Okay. All right. So let's focus on next week. I'll post my trigger list and we'll just trade few stocks and try to, you know, hit big on these. Okay. All right. Good night.